Wait. Good morning, everyone. Hello, grazie mitenan, salud, buongiorno. A very warm welcome to today's Refinitiv webinar, the second Reuters Economic Forum that we do in Switzerland. And for those of you who do not know me, my name is Ortega, and I am leading the customer success team across Germany and Switzerland, working with a fantastic team of specialists across the buy side and sell side, ensuring that our financial community gets the most value of our Refinitiv solutions. Today, I will be your host, and I'm well accompanied by your moderator, Rob Cox, global editor for Reuters Breaking News at Reuters. But before we begin, let's cover a few housekeeping items. If you have any questions during the webcast, you can submit them through the Q&A widget. We will try and answer as many as possible during the session, but if we run out of time, we will answer them via email. Please do know that we are capturing all questions. Now, to facilitate the communication flow and keep the session as interactive and as lively as possible, we have designed some polls that we will push out during the session. So please do participate. We want to feel you. And also, you will find out more about our speakers under the speaker bio widget. Now, for the best viewing experience, we recommend closing any programs or browser sessions that you might be running on the background. This is just to preserve your bandwidth. And if for an unknown reason your screen freezes, know that you can just simply press the refresh button or F5 on your keyboard. We value your feedback, so do please complete the pop-up survey at the end of the webcast. We will be recording today's session, and an on-demand version of the webcast will be shared with you in the coming days. And now, without further ado, I'm honored to introduce our speakers. Welcome, Charlotte de Montpellier, economist at ING. Ronald Indergand, head of short-time economic analysis at the State Secretariat for Economic Affairs. Daniel Kalt, Chief Economist and Chief Investment Officer, Switzerland at UBS Switzerland. Lastly, Daniel Lampard, First Secretary and Chief Economist of Swiss Trade Union Confederation, SGB. Lastly but not the least, back to our moderator, Rob Cox, Global Editor, Reuters Breakingviews at Reuters. Rob, the floor is yours.
Thanks, Anna. How are you? Thank you very much. Thanks, everybody, for tuning in on this fine, at least it's a slightly chilly, cloudy day here in Zurich. We've got a lot of ground to cover. I want to kind of kick off quickly. I was just listening this morning to one of the panels at the World Economic Forum, the virtual World Economic Forum, and it's kind of interesting. Someone referenced Guy Parmelin, who is holding the Swiss presidency at the moment, or starting this year. When he kicked off the whole thing, he said that a crisis is a productive state. You simply have to get rid of its aftertaste of catastrophe. I think it was a paraphrase of Swiss writer Max Frisch. But let's use this as a starting point to determine a little bit, maybe as a starting point to determine where Switzerland is in this arc of the global pandemic catastrophe, at least from an economic standpoint. How do you guys see the sort of current state of affairs? Where is the Swiss economy right now, and where do you see it performing in 2021? I'll start with you, Ronald, if I could, and then I'm gonna do Daniel. We've got two Daniels, so I'll have to make sure I'm speaking to the right Daniel each time. But why don't you kick it off, Ronald?
Yeah, thanks. Hello, everybody. Well, I think overall, during the past quarter, Switzerland has weathered the crisis comparatively well, if you compare it with European countries, for example. Now, of course, the new restrictions have kicked in Europe, both in Europe and in Switzerland. However, what we have seen so far is that the second wave hasn't had as bad as an influence on the economic development so far. Overall, world trade has remained relatively robust. And I think also firms have become more adaptive, their online sales channels established and so forth. So going forward, as a large part of the vulnerable group might be vaccinated by the beginning of Q2, and together with the warmer temperatures, of course, as well, we expect the economy to get on its feet quite quickly. And going forward, as long as financial markets and the credit market remains robust, we remain cautiously optimistic for the outlook and expect pre-crisis levels to be reached towards the end of the year. That's the overall picture.
So what do you think the second quarter then is? You think there's growth, or do you think we're looking at?
Well, in the first quarter, of course, we look at the negative figure. The economy has remained surprisingly stable during the second wave in Q4, so we might actually see a black zero in terms of growth. But in the first quarter, of course, the restrictions will kick in, and the first thing we're going to see is a huge drop in card transactions. That will be one of the first data coming in. So that, of course, will hamper private consumption, and therefore we're going clearly see negative growth rate in Q1. As for Q2, we are actually quite optimistic that the bounce back may be around the corner.
Okay, and you mentioned vaccinations. I want to sort of park that for the, I do want to come back to that after this, but let me go to you, Daniel, at Daniel Lampart. I mean, what is your sort of base case for Switzerland in growth in the next first half and beyond?
Well, best case is that we can leave the situation as soon as possible, so to lower unemployment in Switzerland, but it's hard to predict where we're going. We depend on these epidemiologists, and also they have really problems to forecast what's going to happen, mutations and so on. So the only thing that we can do to lower unemployment or stabilize unemployment is to take or increase our stabilization measures. I was told yesterday that people demanding short-time work is increasing. That's not surprising if you lock down a part of the economy. So we support every measure. We lack some measures for older unemployed, for example, that they don't have to leave unemployment insurance. So I hope that the Swiss Federal Council will decide in the next days. And the supporting measures in this cantonal funds, let's say. So the money is there, but they have problems to give the money as quick as possible to the firms that are now locked down or in danger.
Okay, well, we are going to actually ask a poll question of everybody here, which is whether the Swiss government is doing enough. I'm going to actually let Charlotte and Daniel chat or speak before we do that, but everyone out there prepare to answer that question. Charlotte, what is your sort of perspective on the Swiss economy?
I think the Swiss economy is doing rather well right now if you compare to other European countries. You must remember that in some countries there were some severe restrictions already in the fourth quarter of 2020, and there are again severe restrictions right now in all European countries, including Germany, but in the Netherlands and France. So it means that actually right now the Eurozone economy is in a recession. We have very bad fourth quarter of 2020 and most probably a very bad first quarter of 2021. Mean that the Swiss economy will most probably do better than the European economy, and of course that was already the case during the first wave of the coronavirus. So the Swiss economy is doing very well if you compare to the rest, even though the situation is quite hard. But still, it's good for the Swiss economy because it means that most probably it will reach pre-crisis level of activity way before the rest of Europe, and that will be. I mean, the recovery will be stronger in Switzerland than in the rest of the Eurozone economy in Europe.
Right.
And
But of course, that was partly because, I mean, if you look back, it was not the restrictions, the stringency was much lower here than it was in, than in France or Belgium, other places. Now, I think as I think Ronald was referring to, it's gone the other way. I mean, you can't go and buy a car, you can't go to a bar, you can't get a sandwich. I've never seen it like this. But you still think that it's really more resilient.
Yeah, because it's also actually right now, Switzerland is in the same situation as Germany and the Netherlands, and maybe France is going to follow the steps. So it means that all in all, the period where Switzerland has experienced some very bad economic situation will be shorter than in other European countries, which means that it will do better at the end of the year if we have to look this far. So that's a very good point. And also we know that right now it's mostly the service sector that is where restrictions are really important. In the manufacturing sector, it's doing way better because the lockdown is maybe smarter than it was during March and April 2020. So it means that I believe that Switzerland's economy is quite resilient through this crisis right now.
Okay, Daniel K., why don't you give us your perspective? I saw a tweet that you put out the other day that said that lockdown, home office, travel bans, the new year also starts turbulently. I think that was how you were talking about a report you had put out. But why don't you give us your perspective on where the Swiss economy is?
Yeah, sure. You're absolutely right. I mean, this second lockdown is a bit harsher than what we've seen in the first wave, but we shouldn't forget that companies and the economy as a whole has probably adapted quite a bit to these new circumstances. And that's why the impact is mitigated by the fact that companies have found ways to still produce. And therefore, we expect this second lockdown actually to have an impact, but not quite as dramatic as we've seen in the second quarter last year. Also, we shouldn't forget, once we can relax the restrictions, we have already seen last year in the third quarter that actually consumers will catch up a lot of what they've been forced to save. And also this time around, we expect actually, as we go into a relaxation mode, let's say starting second quarter, that we will see catch-up demand kicking in. So the economy will rebound quite strongly, similar to what we have seen last year.
Yeah, so I remember might have been like April, May, June, I remember going down Bahnhofstrasse, and a lot of people were, and they'd see like the queues of people in front of the Louis Vuitton or the Gucci shop. I guess there's a term for this called revenge spending. Some people are using, right? So
that's a good word.
Yeah,
right.
I mean, I feel like I'm ready to do some revenge spending. Okay, let's ask everybody out there. You can let's put the poll question up, Magda, which is sort of in reference to what we've just been discussing. Is the Swiss government providing enough stimulus to the economy to cushion the impact of the pandemic? I'm not sure exactly how you do this, but there is a poll.
Yes, so Rob, 55% of our attendees say yes and 45% no.
45% no, so 65%. We have a very conservative crew out there, huh? They think that everything's there's already enough stimulus. Okay, well I think one of the preconditions for well, actually, I'll give you. I was listening this morning to Anna Botín, who is the CEO or chairperson of Santander. She was saying the best economic policy for 2021 is an aggressive rollout of COVID-19 vaccinations. But that doesn't seem to be happening in Switzerland. I'm not sure. There's a sort of sense that it's been delayed. You look at the UK, you look at the way they've rolled out the vaccinations, even the US, which certainly has not been an exemplary handler of this crisis. Switzerland, I don't know, I went on the other day, it looks, the numbers coming out were really quite low in terms of the vaccination rollout. How important is vaccination to this equation, or to your equations, and you're thinking about the rebound? Let me start with you. Let me kind of give it a perspective from Europe, Charlotte. What is your sense of where does vaccinations roll into this?
Yes, of course, we know that the vaccination campaign is not as that fast in Europe generally, and in Switzerland it's the same. However, it seems to be accelerating, and we can believe that it will accelerate when a vaccine will be more and more available. But so yes, I mean, this is really important. This is the step one for the recovery, but I think it's not the only thing that we need to follow to have a sense of the recovery coming in Europe, but also in Switzerland and in the world. We must be aware that budgetary policy and also monetary policy are very important as well, and it seems that all over the world they are going to remain very much accommodative. Look at the US, where the stimulus plan is huge, which will have a strong boost. I mean, it will have a strong boost on the economy in the US, but also in the world, and so also in Switzerland. So I think the vaccine is very, very important, but then we also have this very accommodative monetary and budgetary policy that are so important as well. And those are, we believe that they will remain accommodative through the whole year, and most probably also in 2022, which means that all the conditions are there to have a strong recovery when the vaccination campaign is sufficiently sufficiently done, which means that I believe that the recovery after the vaccine will be quite strong, actually, both in Switzerland but also in the rest of the world, and that's very positive in that sense.
Yeah, we can return to the sort of monetary and fiscal policy, but monetary policy later. I'm quite interested in some perspectives on that. Daniel Lampard, I mean, where does you're representing the trade union there? I mean, is there a sense that Switzerland is, behind the curve in terms of getting the jab into people, getting the vaccinations out? Does that worry you at all?
Everything is worrying us in this crisis, I have to say. Well, vaccination is a very important instrument, mainly for the vulnerable people, the older or the people that were ill. But we have also to account that there are perhaps 10 to 20% of the Swiss populations that are already immune because they had the virus. And it's a bit hard with the administration to have a clear view on this topic. There are some surveys made, but I think they're a bit hesitant in really appreciating that there are a certain part of the population that needn't be vaccinated in the coming month. To me, that's a positive aspect. Nevertheless, I agree with Charlotte that we had to do everything to get our economy intact. That means abolishing closing of firms, abolishing unemployment, so that we can start as quick as possible if there's an end of the tunnel of this virus story, by vaccination, by natural immunizations, perhaps by other measures. And for us as a union, that's a main topic. That means supporting firms, supporting unemployed, short-time work, stay on the course that we've been up to now with quite a success. And then there's a big chance that we can start with a really lower unemployment level that we have today.
Ronald, I mean, where does you're closer than the most of us to the actual government. So what's the sort of thought thinking in terms of the importance of getting those vaccines rolled out? I mean, and I think it's really interesting what Daniel just said, that there's this sort of, there are these questions that remain unanswered about, who should get it or where it should go, I suppose. I went on to the Zurich cantonal website to find out about it. Sort of basically says call back in April. What's your sense of how should we be looking at this issue, Ronald?
Yeah, well, of course, I agree. Vaccination is very important. And currently, it may be true we're not in the fastest group of countries, but it's being rolled out, and we're confident that we will be able to catch up in the near future. And vaccinating is being targeted, of course, towards the most vulnerable groups first. and then being rolled out to the rest of the population. And we do believe that this is going to help a lot in terms of getting people immune together with those, as Daniel mentioned, with those that are already immune, and that then the restrictions can be eased in the course of the first or at least in the second quarter. Maybe I can get back with a brief words concerning stimulus. I think it's important to distinguish between stabilization and actually stimulating the economy. Now, in the very short term, as Daniel pointed out, what we need is stabilization. Stimulating the activity is actually not what we want. We want people to stay indoors, right? Or at least not get in touch with others. Now, in terms of the fiscal impulse we have seen so far, according to our analysis, Switzerland actually stands out with a very high fiscal impulse if you compare it to the drop, to the economic drop that we have seen. So I think Switzerland actually stands out as a country that does rather much. Now, in the medium term, then, of course, the most effective expansionary policy is easing economic restrictions in the course of the year, and a new stimulus might be appropriate, say, if a depression-like lack of demand or a profound investment weakness should kick in. But this, so far at least, is not what we have seen. So as soon as the restrictions are eased, we have seen after the first wave already, the economy jumped back on its feet quite quickly. And so far, we don't see major problems on the credit and capital market. So firms that want to invest, they should get the capital they need.
Daniel Kalt, your thoughts on this? I mean, one thing there is the sort of, if we're right, okay, let's set aside the vaccinations come through, warm weather comes back, and revenge spending returns, and people are excited. I mean, is there a possibility that that inflation targets are overshot? Not that ever happens here, but is there some? What is your sense of how the vaccinations and the rest will impact sort of the rebound, the growth?
Yeah, the vaccines are certainly the key to open up the economy again as fast as possible, and we're not really fast in that respect. We have to admit. I mean, we were very efficient in supporting the economy. That was a very effective program, but the vaccine program is really slow. And if you look at the rankings that are out there, Switzerland is really in the lower ranks, behind Cyprus, or just I think one place ahead of Estonia, and I think we should be a bit further ahead there. I don't know why we are so slow. But of course, this is really key. And the question is, how fast will this rebound come? And there's discussion, of course, because I think there are a couple of sectors which are very hardly hit, but a lot of other sectors are doing pretty well and normal. I mean, if you look at construction, if you look at production, we see demand kicking in again for machinery goods as Asia powers ahead now. It's really the domestic sectors like retail, services, which are hit hard. And if we open up that again, I think we could end up in a situation where economies are reclaiming a lot of their lost output gap relatively fast. I think there's already a big debate about that also internationally, in the US, for instance, where people are discussing whether the big spending pack which Biden now proposes is too much and could lead to overheating in a year's time. It's absolutely thinkable that we may run into an economy which is firing on all cylinders once we have left the pandemic behind us. Absolutely thinkable. Hard to say how fast because there's so much uncertainty about the virus, whether there's mutations and so forth. But if we go along our base case, which is that we can open up the economy again, starting in the second quarter, we could rebound relatively fast.
It's a good question. I couldn't quite understand why Switzerland was so behind on the vaccine. That's another question for another panel, but it struck me as quite yeah, you mentioned Cyprus and Estonia, and you look by canton, I was like, even here in Zurich, like, what's going on? This is Switzerland. It should be so much more efficient. But set that aside. Let's ask the audience question, which is the next one, with the poll question, which is: do you plan to get vaccinated against COVID-19? Please answer the question. Let us know. And Anna, maybe you can give us in a couple seconds a rundown. I hope the answer is like 95%, but who knows?
Okay, let me just open the poll. So 24.5% of our audience is not sure yet if they are going to get vaccinated. 61 yes, a sound yes, which is really, really optimistic.
Okay, well, if we have 61% plus 10% that have already had it, I guess we have herd immunity. But I don't know. I'm only pretending to be an epidemiologist. Let's talk a bit about relations between Switzerland and the rest of the world a little bit. So one of the sort of questions is whether you guys think that Switzerland's treaty with the EU can be saved, given sort of the broad range of domestic opposition we've seen here, whether we can get an overarching argument between Brussels and Switzerland, and whether or not that matters, or how that matters, and how that goes into your thinking about growth and Switzerland's prospects. Let me start with you, Daniel, since you started last on the last question. I'm going to give you the first thought on that. What do you think should happen here with the EU?
Sure. I mean, short term, it will not hamper our growth potential or our ability to trade too much if we don't get this institutional framework agreement immediately. But over a longer term horizon, I would say this could really become an issue, because we all know that we should find a way how we can dynamically incorporate changing EU legislation into our bilateral treaties and have open markets, because open markets has always been really a success principle for Switzerland. Participating in global trade is really important. So I'd say it would be good if we could make sure we get this arrangement with the EU. Of course, we have a couple of issues which are still open and where the Federal Council is discussing, and a couple of points which are a bit critical and which especially lead to opposition from within the country and on both aisles of the political spectrum. And that makes it so difficult to get it through, because we have resistance from the very right, and we have resistance from the left, from the unions on these labor protection things. So that makes it increasingly difficult also to bring it to an agreement within Switzerland.
Daniel, I mean, you obviously are close to the trade union's perspective on this. What are your hopes, or what do you think the prospect is of getting some sort of agreement, and do you think you could even get it through the electorate?
For us as unions, it's clear that only an institutional agreement would be acceptable that let us our wage protection as it is now. And that's a hard topic. We are not sure whether the EU Commission would agree to that. So we have results in the coming month. Besides that, it's always hard votations concerning a better relation, or a more approximation relation to the European Union. And we need a double majority in the population. That means a majority of the population, but also more than half of the cantons that have to agree. So that would be hard in any case. In my view, it's always dangerous to negotiate formal things. I prefer negotiating on material things. That means how can we have a better exchange in digital aspects, perhaps other topics, health topics with the European Union. Negotiating a conflict procedure, let's say, as it is in this institutional agreement, in a bilateral relationship, that would be hard. And to me, it's clear if you have a bilateral relationship, there's a bilateral logic also needed in the how do you get along with conflicts in this agreement. And the question of the European Court of Justice, also all the question of dynamization would be hard to convince the Swiss populations to accept that.
Ronald, what's your perspective on this? I mean, like anything, this has to be sold to the people. And in a sense, that takes leadership. That takes someone going out and, basically putting forward something and saying, these are the arguments for doing this and approving this. Do you think that's possible given sort of the political climate?
Well, that's very hard to say, but of course I agree that this is of utmost importance, right? I mean, the European Union, as we all know, is the largest trading partner by far. So we really need good relations with our neighboring countries in the medium and long term, and that's why, of course, we pursue the institutional agreement as a part of this way of bilateral treaties that we have been following. And as Daniel mentioned, Swiss firms require access to the European market as broad and smoothly as possible. And if we do not follow this way, we risk a gradual erosion of market access for many firms in areas where regulations are developing further in the European Union, and that's certainly something we need to avoid in the long term. Now, whether we are going to be able to sell this to all the partners, such as trade unions, the public, and the other side of the aisle, is a very good question. But I'm confident that everybody, we agree on one thing: we need good relations. Right, with the European Union, and therefore I'm confident that we are going to find a solution in the medium term. Yes.
Charlotte, you're in the European Union, unlike the rest of us here. What's your perspective?
Yeah, I must say I was a bit amazed that after the deal with the UK, there was a lot of talk in the press saying that maybe Switzerland should follow the same path, or maybe this is a good news for Switzerland, because we must remember that the relationship between the UK and the EU is not the same as the relationship between the EU and Switzerland. And actually, Great Britain had actually a worse market access than Switzerland to the common European market, and now the access market is even worse than before the deal. So I think it's important to realize that we are not in the same situation, and I know that there was some talk about the fact that in the EU case, they were able to not have a role to the European Court of Justice in the agreement, and maybe Switzerland could follow this kind of path. But of course, since the access to the market is quite different and is quite weak in case of the UK, this is not the same situation at all. The only good thing I think right now with this deal with the UK for the Brexit agreement is that now the European Union have maybe more time and and a stronger willingness to spend to talk with Switzerland. And I believe in the end, both the EU and Switzerland agree that we should improve the partnership, the way we deal with each other, and the access to the market for Switzerland to the European market, but also for European companies to the Swiss market. So, I mean, they agree on that. That's a very good starting point. And everyone seems to agree that we need to have a deal at some point. Of course, on technicalities, maybe it will be very difficult. And I cannot say that I'm optimistic about that, because we have seen with Brexit that it takes so much time, and at the end, the results are a bit disappointing. So it could be that at the end, we are a bit disappointed with that. But the good thing right now is that, everyone seems to want to have a good relation, and that's a very good starting point, I guess.
Let's ask the question here of folks. There's another poll here. Should Switzerland adopt the institutional framework? agreement with the European Union? Please give your answer now, and then Anna will give us your the instant feedback on your perspective there.
So already some answers. So 61% of our attendees vote yes. We should adopt the institutional framework. 61%.
Okay. More or less the same number of people who say they're going to get. Yeah. Yeah, but now you have to get all the cantons too. So good luck with that.
Yes.
Okay. So let's talk about another trading partner, which is the second largest trading partner, which is the United States. Which sort of brings us to talk about, I think we're going to have to talk about the franc here. The Swiss National Bank says they're trying to make a strong currency less strong. According to the U.S. Treasury, that's market manipulation. That's currency manipulation. And the SNB has spent something like $100 billion a year on that effort. Hasn't really worked, as far as I can tell, given when I have to translate things from dollars to the franc. We haven't seen the franc rise. We haven't seen the inflation target reach, and it's had it has annoyed the United States, one of Switzerland's biggest export markets. What's your perspective here? Is the Swiss National Bank misguided? Does it need new leadership? Does it need new ideas? Is Thomas Jordan the right guy for the job? I mean, I'd love your perspectives on this. I'm going to start with you, Daniel K.
Okay, okay. I will certainly not directly answer your questions about Mr. Jordan. That's not me to have a say on this one. I think that the other Daniel is perhaps a bit closer to that, as he sits in the board of the Swiss National Bank. So, no, of course. I mean, this is a delicate issue. We all know that the U.S. has accused us of manipulating the currency. They very mechanically look at 3 criteria, and 2 of them we fulfill since years because our trade deficit or surplus with the U.S. is huge, and also our current account surplus is huge. What made the 3rd criteria tick the box now is the currency interventions that we've seen last year, which were more than 100 billion, I would say, roughly around that, to keep the Swiss franc mainly from not appreciating below 105 against the euro. So it's mainly the euro they're targeting and not the dollar. Because when the dollar Swissy was around 1, the Swiss franc was actually a bit strong against the dollar, or a bit weak against the dollar. But now with below 90, I think now it's actually strong against the dollar. So there's no reason to think we are really weakening the currency beyond what is a fair value. And also we think that if the economy progresses and we see this recovery going on, I think the SNB will likely not have to intervene anymore throughout this year, if we're lucky, because the euro should rise in that environment. And therefore by the mid of this year, we may get off the list again because we will not have more than 2% of GDP in currency intervention. We've tried to simulate that, and if the SNB just can sit still and doesn't have to intervene anymore going forward, this problem should fade.
Right, Daniel L., what is your perspective? I mean, why is Thomas Jordan still the guy for the job?
To me, it's not a problem of persons. It's a problem of logic and structure. But perhaps on the franc itself, exportations of Swiss industrial machines is on the level of 1988 now. I was shocked when I saw these figures. And also the electric product, let's say, as transformers and so on, production in Switzerland is really suffering because of the overvalued franc, and electricity is the energy of the future. So Switzerland has to be strong, has to be in the lead in the production, in the development of such products. And it's quite hard for these firms in Switzerland. We have dismissals in several firms as General Electric and so on for several times last years. So that's one topic. To me, it's clear the franc is really overvalued, and it's a big problem for our economy, not only for the exportation. Because if you have a look at investments and investments in the future of the Swiss economy, let's say digital investments, ICT, also research and development, our growth of Swiss investments in this category is weaker than in the Eurozone. And the Eurozone is in a crisis. So I'm really worried about the future, about the evolution of key sectors, of key investments in Switzerland. And I think this is really underestimated in our view on the foreign exchange question. Now, the Swiss National Bank has the monopoly of producing francs, so they can, in fact, economically, they can make what they want to do. It's a question of instruments. Foreign exchange interventions are effective, but what you need is a clear communication. That means formulating objectives concerning inflation. We have the minimal exchange rate regarding the euro, so that this minimal exchange rate had been abolished by Jordan and his team. So that would be hard to reintroduce, but you have many communication possibilities, formulating objectives, intervene in the foreign exchange, and make clear at the markets what you want to do and where you want the Swiss franc to be.
Yeah, I was speaking with one of the founders of On Running a few months ago. I'm sure you guys know the brand. You probably have a few of their fancy sneakers in your closets. And he was saying one of his dreams was to one day manufacture their products in Switzerland. But labor costs, high price of the Swiss franc made that virtually impossible. The best they could hope for was a fully automated factory. I wasn't sure, and then they might do that. They have this plan to create these sort of like sustainable shoes you can just recycle. It still costs a fortune, but I mean, what concerns do you have, Ronald, about whether it's labor costs, but we can set that aside, but just the franc. I mean, just in terms of the productive economy of Switzerland as a result of the franc. What's your worry about that, or maybe you're not worried?
Well, of course, we are worried during periods where sharp appreciation shocks arise. I mean, we have seen 2 times already that this is influencing the business cycle. But then, on the other hand, what we also have seen that the Swiss economy has always had a strong franc, and firms have been able to live with that. And also after the last shock in 2015, yes, we've seen a slowing down of the economic development, but we have not seen a huge recession. I mean, overall, I think, yeah, of course, I mean, many firms and several sectors have been hit hard, but in the medium term, they have actually been able to cope with this situation quite well. Having said that, of course, it's a risk for the economy overall, because the Swiss franc, as we all know, is a safe haven, and therefore the arguments for the interventions that the Swiss National Bank is doing are quite obvious. Also, I think the coming back to the manipulation argument, the criteria that U.S. Treasury is following are very mechanical, and in our view, not very sensible. I mean, to give you an example, they focus on 3 criteria, and one is goods surplus, bilateral goods surplus, and there, yes, we have a huge goods surplus with respect to the US, but this is ignoring services. I mean, concerning services, we had a huge deficit such that in 2019, the trade balance overall was largely balanced. And overall, I mean, there are good reasons why the current account is in line with fundamentals, as the IMF agrees. And we are also confident that we, with the good relations we established with US, that this is going to continue.
Well, of course, you got lucky in the sense that even though there was a trade surplus with the U.S. in, as you say, goods, for some reason Donald Trump never seemed to look at Switzerland. Didn't have a problem with it. I guess he's trying to get a golf course up or some sort of contract here. But I mean, do you think that there'll be a new? Is there a new? The Biden administration, of course. I mean, what's your hope, or what is your sense of whether the Biden administration's approach to Switzerland will be different than it was?
I mean, it's very hard to say. I mean, as you mentioned, we did have very good relations with the previous administration. Now, of course, it's actually written in their law, and they have to follow, obviously, their law that they have to approach us. And this is going to happen. So talks are going to happen during this year. But we are quite confident that also the new administration acknowledges that we are a very important partner. We are the 7th largest in direct investor in the US. We employ hundreds, Swiss firms employ hundreds of thousands of people in the US. And I think both countries have an interest in getting along with each other.
Yeah. So Charlotte, what's your sense of the new administration in Washington's approach, not just to Switzerland, but certainly Switzerland, but just in general? I mean, how do you see it shaping up in terms of the impact it might have on trade and European growth?
Yeah, so I think the relation with Europe and more generally the world will be more maybe easier with the Biden administration if you compare to the Trump administration. And we know that there is a strong hope in Europe that it will be easier to talk about tariff or what kind of geopolitical relation we want with each part of the world. So that would be that should be easier. At least this is the hope right now. But we should not forget that still the Biden administration will still wants to put the US first. Of course, it's their role, but okay, it should be calmer and easier than before. The good point for that and for the Swiss National Bank is that if the geopolitical and international context is easier and there is a strong economic recovery thanks to the vaccine, then there will be maybe less pressure on the Swiss franc, and it will mean that the Swiss National Bank won't have to intervene as much as it was the case in 2020 and 2019 to weaker the currency. And it means that at the end, maybe the issue will solve itself because of the more positive global context. We will have less pressure on the Swiss franc, will appreciate less, and then can lead to less intervention from the Swiss National Bank. And at the end, the issue can stay there, but there won't be. I don't believe there will be some escalation of tension between Switzerland and the US. So that's a good point actually, and maybe also we will see with the global recovery that we have some inflation pressure coming up, and that will be also good for the Swiss economy as well, and for the global economy. It means that the recovery being stronger, there is an economic activity, and at the end we know that for Switzerland, since the deflation risk is so important and so big, it will be better for that. So I'm quite optimistic on the fact that the recovery will lead to a better situation, and also on the fact that the new administration will lead to an easier international context, and that will also help the recovery more globally.
Yeah, that seems right. It's a collaborative and cooperative approach, even if it is still, like any country, America first, I suppose. But let's go to a poll question here about the franc. I think the question is the Swiss franc still significantly overvalued? Why don't you go ahead and answer that, and then Anna can give us your perspective. I think everyone's going to say. My guess is if it's 61% again, I'm gonna go crazy, because you can't keep.
No, actually, it's very
consensus.
Rob, it's 50-50%.
50-50, okay. So, well, it's not 61% again. That's good. That would have been way too predictable. I want to ask a kind of question. We'll open it to audience questions shortly. I have one kind of question, sort of a broader one. As a journalist here, one of the exciting financial journalists is, in late November, there was a referendum on corporate responsibility. It was approved by a majority of the population, if not by enough of the individual cantons to be approved. But I'm just wondering what this tells us about the economic or business environment here. What sort of bigger, broader question? Let me start with you, Daniel L. Was there any lesson to take away from this about just the economic and business environment in Switzerland as a result of the referendum in November?
Well, that was a legitimate question that was posed by an initiative, means a mandatory referendum, as it is often in the case in Switzerland. That's the positive aspect of our country and our economy, that as soon as such questions are on the table, they are also in the political arena. We have to discuss, and at the end we have to vote. Well, it was around 50-50, double majority. At the end was that the conservative part of Switzerland won this votation. But I won't exaggerate that. I don't worry. We voted many things in the last years. And for me, that's okay. It's a kind of a participation of the population that also leads to a legitimization of the Swiss political decision, but also of the environment, of the economy, of the firms, of the working places.
And what about you, Ronald? What's your perspective on whether, this thing just go away, it's never going to come back, or does this reflect some shift in the way that the Swiss people see big business? And will that have an impact on
hard to say, honestly. I wouldn't worry too much concerning that particular question, but what I can say, of course, is that we have to remain cautious. It's important that the country, the environment for firms and also workers in the country remains competitive and attractive. I do believe that Switzerland still is attractive, even though you may have discussions every now and then on such topics. But I don't think that it fundamentally puts in question the competitivity of the country. But maybe Daniel K is better in.
What does the UBS do with that, Daniel?
It's a very good question. This referendum has shown that concerns in the population about the environment, social standards, governance issues are certainly on the rise. And it was a very tight referendum, of course. And I think we see that also in how our clients act when they decide about investments. So what we see is a big interest in sustainable investing. So investments, putting together investment portfolios which follow these ESG criteria. So environment, social, governance issue taken into account. And I think that's a good way how the finance sector can help make this a better world by channeling savings into users which actually care about environment, social, governance issue. I think we shouldn't do that by bans and commandments as this initiative wanted, but we should use market mechanisms in order to find ways how to change the world. And one of these is if banks provide their clients solutions which take into account these factors, these ESG factors. And that will exert a lot of discipline on companies on how they behave. So that's really a market solution which we can help provide and make this a better world.
Let me ask, there's a couple of questions here that linked that we have here. I'll sort of throw them out. One is, how do you believe the big amount of money, so I guess fiscal and monetary stimulus that's going to the market, is going to impact inflation? And sort of correlated to that, do you see the huge amount of debt being written by governments as a longer-term recovery risk? So, do we see debt problem, and do we also see an inflation problem as a result of that stimulus? Let me start with you, Charlotte. What's your perspective on that? We kind of covered this a little bit, but I just want to answer the audience questions here.
Yeah, on inflation, I think there was a huge amount of money created by central banks and used by to buy some bonds from the governments to help during this crisis. But let's remember that this huge amount, the huge amount of money is not circulating into the economy. So it means that for me, there is not so much a risk of inflationary pressure because of monetary policy. I don't see that such as a risk right now. I think monetary policy actually and budgetary policy did whatever that they could to help the economy through the coronavirus crisis, and actually it helped very much, and I believe it will continue to help for the recovery in 2021 and 2022. So I'm not really much afraid of inflationary pressure based on that right now. This does not mean that we won't have any inflationary pressure. Next year, we know that just with the base effect on energy prices, we will have some inflation, and in some countries, inflation can reach 2 or 3%, like in the US. Some may believe that it's concerning, but actually it's more a temporary factor, and it will go back to normal at a certain point. It's not that we have some very big pressure there, and that will remain for the next years. So on that count, I'm not very pessimistic about that. Regarding the debt, of course, we have seen all over Europe, in the US and in Switzerland, but mostly in Europe and in the US, that the amount of public debt has increased so much. And that could be a problem at some point. But let's remember also that governments right now are borrowing money at 0 or negative rates, which means that debt services are not that huge. And it means that it can remain sustainable if it was only for a short period of time, and at a certain point we go back to maybe what was the case before, mostly in Europe and in the US. In the case of Switzerland, with this global, this debt break mechanism, Switzerland has actually all the means and can do whatever with that debt, and that's very good. It means that for the next years, it can still use some public spending to stimulate the economy. So if they decide, the authorities decide to use that, it means that Switzerland can actually be really better than other European countries in 3 or 4 years.
Even if our 61% of our audience thinks that they've already doing enough, maybe that's an interesting contrast. Daniel L., what is your perspective on this question of long-term debt, the impact of long-term debt, and the impact of, in the shorter run, fiscal stimulus and monetary stimulus on potential for inflation?
Yes, perhaps first on inflation. If a condition for inflation is that we can negotiate wage increases as unions, and firms can increase their prices. And we have an output gap or an underemployment of about 5% or more. And in such an environment, it would be hard really to get quick in an inflation environment. But how can we negotiate wage increases? The wage negotiation 2020 for 21 was really hard. Many zero results. So, but we're looking forward to an inflation environment. That I have to say. Other thing, indebtment. I think it's not really known in Switzerland, but the Swiss state has an equity of about 100 billion to 200 billion francs. So we're absolutely not indebted, not as the Norwegians. They have an equity that's higher than in Switzerland. And I think it's time now to give money back to the population, and COVID crisis is, I think, a precondition that there are not only stabilization packages, but also stimulation packages for the second half of this year. Because if you have an underemployment of 5%, I think it would be very optimistic to assume that this would disappear quickly. And in my opinion, there's a stimulus needed to get as soon as possible on an unemployment level that we had before the crisis.
Ronald, where are you on that perspective? Is the government in that position where it sees stimulus in the second half as a kind of necessary precondition?
Well, I mean, as mentioned before, so far we don't see. I mean, we have to wait and to see how the economy is doing after restrictions have been eased, and then we are in a position to better see whether we really need further stimulus that goes beyond the stabilization measures that we have in place and that are also internationally large. As for that in general, yes, I mean, that is a risk. Companies and especially countries come out of the crisis with massively elevated debt levels. Now, Daniel is right that Switzerland is generally in a good position thanks to the more conservative approach that we've chosen in the past decades. But internationally, things are different. At some point in the longer term, we must see some sort of fiscal consolidation. That means either less spending, higher taxes, or another form of consolidation, such as inflation or in the worst case, haircuts. Let alone debt crisis. So this is clearly a risk for the recovery in the longer term. As for inflation, my answer to your question 10 years ago would have been a loud yes, but we actually have been waiting for inflation for about these 10 years. So it's actually hard to say. As Charlotte says, we said already we don't, and I agree, we don't see feeding the monetary impulses through to the economy. So we don't see a massive surge in inflation in the very near term, but this is a risk going forward. Now, if we were to see these high growth rates, say next year, as Daniel Kalb was implying or pointing out as a possibility, then we might indeed see a rise of inflation rates. And if inflation rises, monetary policy might have to become more restrictive, and that would really be the risk, because that would mean that the high debt levels might quickly become a problem internationally. So that's clearly a risk in the medium and long term for us.
And Daniel Kalb, what's your view on debt and inflation?
Yeah, I mean, absolutely right. In the longer term, and we're talking 3-4 years here probably, if inflation should really rise and accordingly we have rising rates, this could become an issue. I think shorter term, next 2-3 years, I think we don't have a problem with the higher rates in highly indebted countries. Why? Because they have immunized themselves against high rates. Because over the last 10 years, even the highly indebted European countries have been issuing a large chunk of really long-term debts. And so they have basically fixed their rates at the very low level. So it would take several years of very high rates, and by refinancing their huge debt books until they really get a problem in terms of indebtedness. It takes a long time of very high rates until this becomes really a problem and an issue. But longer term, it could be one, absolutely. Short term, I don't think we have an issue. Also, inflation has always been a global phenomenon, and I think so we need to see inflation rise globally. And my concern is Europe will not get out of this, because output gaps in Europe are even much larger than in Switzerland. We have much more slack in the economy in Europe, especially in Southern Europe. So I think we're just sitting on the wrong continent here in order to get a bit of inflation in Switzerland.
Oh, so Japanese sort of stuff, maybe deflation or something. Okay, one last question. It's come in from the audience. Do you think the equity markets? Okay, the question is, do you think the Swiss market index will increase in the rest of the first quarter? I think that's rather narrow. I just sort of maybe just a question. I'll actually keep it with you, Daniel K. What is all of, if you take your perspective or some of the perspective we've discussed here, what does it all mean for investment? What does it mean for equities? What is and then, and I give it to you because UBS obviously has a house view on this, but what do you think the read through is from an investor perspective here?
Yeah, I mean, we have seen equity markets recovering very, very strongly and fast from this pandemic. And it's to some, it's really astonishing how fast financial markets have returned to courant normal. Of course, we see some sectors where we have a bit concerns and we see signs of overvaluation, especially in the large mega cap tech sector in the US. But if we really manage to go into this recovery, we feel that markets can continue to climb, especially those sectors which have underperformed last year can catch up. That's absolutely possible. Also because we have this TINA environment. There's no alternative to equities, actually, because on the bond side, you earn nothing. And there's a lot of cash on the sideline, which is still waiting to be invested. So actually markets, as long as we don't have a mutation of the virus and if we fall back into a really deep recession, I think we have good chances that markets can go up. Not everywhere, and we may see some sectors suffering a bit. Yep.
Charlotte, what's the ING house view on this?
Yeah, I think the view is quite similar. So there is a strong probability that market will go up at some point. But let's be aware that we expect some volatility in the short run because of those new variants of the virus, bad news on some economic development or in some sector developments. So it means that even though the tendency is quite positive, in the short run, we could still see some volatility, and it means that it's always important to be a bit cautious on what we do with that, I would say.
Okay. Well, look, let's leave it there. Thank you. I want to thank Ronald, Daniel K, Daniel L, Charlotte, Anna for putting this together, and I hope everybody has a better 2021 than the first few weeks would portend. Thank you.
Thank you, everyone. And just last word, thank you to everyone, the panel, but also the attendees, and for the lively discussions and the questions. As mentioned previously, there will be a link sent to you in a few days with the recording. We will try and answer those questions that might not have been answered already. And I think we can agree that the future is bright. There is light at the end of the tunnel. We feel that the economy is resilient enough to overcome the pandemic versus our peers. And we talk about stabilization, not a stimulus, and volatility in a market that is slowly recovering. Thank you, everybody, and stay healthy, and looking forward to the next session soon.
Bye-bye. Thanks.